Let's get into the mailbag. I've been given one question. It looks like a three-part question, Robert.
Oh, goodness. Three parts. I don't know if I'm smart enough to answer a three-part question being from Louisiana. I'll give it a shot.
How do you go about determining what is the best and most appropriate portfolio allocation for a client? What would make this change over time? And lastly, is your suggested allocation at all dependent on market conditions at the time? This is from Steven.
Steven. Okay. Well, thank you, Steven. So read the first part. Let's go sector by sector. Maybe you can jump in as well.
How do you go about determining what is the best and most appropriate portfolio allocation for a client?
That's a very good and interesting question. I would say there's no one size fits all. Many firms, and I don't want to bash or pick on any firms, but many firms have one portfolio. It doesn't matter if you're 30, doesn't matter if you're 100 years old. Doesn't matter what your risk tolerance is. They just have one portfolio.
Tax bracket, risk
None
tolerance, nothing. Yeah.
Right. So we talked in another episode about 90% of advisors don't build financial plans. So here's what normally happens. If they have one portfolio, everybody fits in that. Everybody fits in that portfolio. Let's say the few advisors out there that do have multiple portfolios. What they'll commonly do is look at your risk tolerance and put you in a cookie cutter model. It's not that simple of an answer.
Sure.
Understanding a client's risk tolerance is a piece of the puzzle, but you have to use that in tandem with what are their goals? What have they told you is important to them? What's the game plan? How are you going to navigate the market? So you use risk tolerance in tandem with the financial plan to come up with a strategy. And if you have multiple investment portfolios like we do, having about a dozen from ultra conservative to ultra aggressive and everything in between, then you can pick an appropriate portfolio for what's going on for their needs and have those hard conversations up front.
Yeah. I think you kind of said this, but to go down further on it, it's risk tolerance, when you think you might need the money, in other words, time horizon, which leads to the next question they have is, what would make this change over time, right? Which I'll tee you up as you get your water there. It really depends on a financial plan, what their goals are. But what would make somebody go from one of our models to another model?
Many people are going to think it's age. And I would tell you a lot of times it is age or when they want to retire. But as you know, one of our oldest clients passed away a few years ago at 101. She was nearly 100% stocks.
Yeah.
And you would think, as you've liked to say in the past, how can you be a fiduciary and have a 101-year-old in 100% stocks? You have to understand the client.
Sure.
What are those funds for? She outlived two of her sons that passed away in their 70s, and this is going to her grandkids who are in their 50s and great-grandkids. So first is, what's the money for? Then you have to look at where the market is. Depending on when somebody wants to retire and what their goals are for, you can look at where the market is, what's going on, and as they get closer to retirement, some things can commonly change because they need that money to live on. So I don't know if that fully answered it, but you might be able to add something to it. Okay.
You need to keep it fluid.
Yeah.
And if the client's needs for cash flow changes, portfolio can change depending on what the goals are. And lastly, is your suggested allocation at all dependent on market conditions at the time? Maybe you can talk about how within each model there's deviation percentage in equities.
So that gives me two answers. So thank you for that one. So let's talk about how the deviation in the models work. So let's say somebody's in a standard 75% equity model. So it's 75% equities, 25% bonds. Well, the market's constantly moving.
Sure.
So it's not going to be exactly 75% equities. And if you're active fee-only fiduciaries, right, and you're actively managing the investment portfolios, then you're going to do the strategy that's worked for the past 240 years. When the market goes up, your percentage of equities goes up. Well, as the market goes up, what did we talk about earlier? Take some chips off the table, lower that equity exposure, and maybe not even back to just 75. If we get some research or some headwinds, there's no crystal ball, but some headwinds that the market may pull back even further, then we could take that 75% equity model that might have 80% equities in it because of market going up. Instead of rebalancing it to 75% equities, we could take it to 68% equities, 70% equities, because we want to have some powder dry to take advantage of the dip in the market.
How about a real life example? This year, due to the tariff talk, Trump tariff talk about increasing tariffs. The market came down. You want to talk a little bit about how we our traders took advantage of that, and we bought some stocks, NVIDIA under $100, a bunch of other ones that are up 20-30% in a month, right?
Right. I remember as we were telling clients over the last 6 months that, hey, there is a high probability that we'll get.
By the way, past performance doesn't guarantee future results. We're not promising anybody that can happen. That happened with some positions with some clients. Not all positions, not all clients.
Great disclaimer. And I remember over the past 6 months, as we were talking about earlier, where we were telling clients, expect a 7 to 15% correction, if not 20, sometime in the next 3 to 9 months. There's no crystal ball, but we felt very strongly that there was a high probability of that happening. So what did we do? Exactly that. In every model across the board, as you know, we decreased equity exposure. 7%, 10%, 15%, depending on the model and how much equities they held. Why did we do that? Well, the market's up. It's doing well. And we're calling clients and they go, well, guys, the market's doing well. Why are we selling? Well, that's when you want to sell.
Sure.
Right? That's the strategy. Take some chips off the table.
But I'm paying taxes.
Paying taxes, but I'd rather pay taxes on gains than no taxes on losses.
Yep.
Right? So then the April 4th, that Friday was April 4th, and then April 7th was a Monday of this year. You know, the market was in complete chaos. It was going down because of the tariffs. Well, what did we start doing? And I love this because it doesn't. You're right. Past performance doesn't guarantee future results, and it doesn't always happen like this, although I could probably give you half a dozen to a dozen examples of where some good calls were made. But I remember Monday, April 7th, and April 8th, we started buying back in. And, of course, there's no crystal ball. We didn't know the market was going to rebound and go up another 10, 15% after that drop. But it goes back to common sense. If we're not buying on a 15 to 20% dip, why are the clients paying us?
Exactly.
So timing in the market does have a lot to play with it.
Appreciate it. Thanks for that answer. Thank you, everybody, for joining us, and see you next time.